everyone's going to be looking to downgrade their budgets, and this is a great place for it. The problem with Costco is that it's just trading at a really slight discount to its long-term valuation. It's 32 times. The long-term valuation is like 37. So, you know, this isn't really a bargain where it is, and the economy is slowing. So it's really hard to get excited. But if you hold it, you hold it. This is, you know, it's not a bad. It has performed well relative to the rest of the retail space.
How much of a bellwether are they, Melissa? Because they're such a unique beast, but then when you describe the selection issues they were facing in November, that feels like it's probably pretty common across the industry.
One of the challenges is that they're just going up against really tough comparisons, but they do have a more affluent consumer, so that could help them in some ways. And then they do benefit, as Gina mentioned, from that element of stretching your dollar more by getting bulk packaging. So they may benefit from people seeing the value and shopping there more.
Yeah, absolutely. All right, let's move on to Lululemon. They're faring slightly better than Costco, believe it or not, this year, down only 5%, on pace to snap a 6-year winning streak still. And for those keeping score at home, they've beaten the street on 18 of the past 20 quarters when it comes to earnings and revenue. That is very impressive, Melissa. We barely even talk about Lulu anymore.
Yes, you know, Lululemon is really one that investors have high hopes about and high expectations for because it is so consistent and it has a lot of pricing power. You know, their goods do sell at a higher price point, and that's attracted a wealthier shopper who, in theory, could be more insulated from the pressure of inflation. So there is hope about strong store traffic during the holidays, strong holiday demand, and there's even a possibility of them raising their forecast. That's what some investors hope to hear today. But, of course, it's navigating a different environment. On the one hand, it's dealing with cheaper freight costs, so it's going up against a time when it was actually flying in merchandise in some cases a year ago.
Right.
On the other hand, it's competing with a lot of retailers that have excess inventory and are marking things down, including athletic apparel.
True, because we're starting to see that become more widespread. Gina, Lulu has matured nicely as a stock. This turns out to not just be a flash-in-the-pan story or even to suffer too much from the liquidity issues that we're seeing this year. So what do you do with it?
Well, so look, Lulu is one that is bucking the trend because, you know, as mentioned, it is a higher priced item. They rarely discount. And this was a pandemic darling that I thought would lose steam, and it hasn't. In fact, you know, the return to work didn't actually cause people to abandon their yoga pants. Now we have enough flexibility in our schedule that you can justify a full complement of yoga pants at home. So, you know, I think that that's definitely, and if you look at their earnings and you look at the expectations, I agree that the expectations are probably, you know, the biggest challenge to this stock is that there are very high expectations and we are going into a slowdown. But if you look at how it's performed so far, it has been exceptional and has done very well relative to other competitors. So, you know, clearly there's a huge affinity toward this brand.
Oh, sure. And I'm curious if that leaves you positive on the stock despite how you feel about the rest of retail, or if you're relatively optimistic about the other apparel makers too.
So I'm actually positive on this stock relative to the rest because they are showing that they have pricing power and they're showing that they have brand affinity. And when times get tough, those things matter.
Yeah, don't they? All right, we'll move on now to RH. Formerly known as Restoration Hardware, the shares have been cut in half this year. Their first down year in 5, but they have risen 4 out of the last 4 reports. And revenue is expected to grow about 16% year over year. Melissa, what are you watching here?
So with RH, it's really more important to think about 2023. I think there are a lot of questions about the housing environment and what that means. You know, they do cater to a more luxury shopper, and that consumer in some cases was buying a second home or redoing their home during that pandemic. That dynamic has started to recede. So what will that mean for 2023? Are these customers able to keep spending on expensive furniture? Or are they also going to feel the pinch going into the next year? They are also pushing into new areas. They recently opened their first hotel in New York, and this is a new channel for them. So what are they going to get out of those new types of businesses? They also launched a new line of furniture. So some of those growth areas could help them during a more challenging stretch.
Wow, a hotel.
Yes.
No wonder they're RH now, not Restoration Hotel or what have you. I see a face there, though, Gina. You're not a fan of that move?
Well, that's just an interesting move, although I could see it if you want everybody to try out your furniture and then go and buy it.
Right.
So maybe it's really just a showroom in action. But the problem with RH is that they they're not a discount. They don't like to discount. They haven't discounted. And I think luxury is going to be really challenging. And here you're actually seeing the impact already. We're already seeing kind of a downward trend in their revenues. And this company is trading very cheap. It's trading at 13 times earnings. This is a company that normally trades at 30 times. But we think it's probably cheap for a reason right now, because not only is the trend down in terms of revenues and earnings, but the expectations are also down. And we're also seeing short interest piling up on this stock as well. So, this one I think is far more challenged.